A new government report warns climate change will cost the U.S. economy hundreds of billions of dollars in annual losses by the end of the century. And we're already seeing the beginnings of this in the mortgage market. Rising risks is this week's cover story, and Diana Olick has more.
Hurricane Harvey flooded close to 100,000 Houston area homes, and the vast majority of them had no flood insurance.
Ultimately ended up about 4 feet.
Jennifer and Andy Taylor did have insurance and at the time vowed to rebuild.
The fabric of the community has been amazing.
But as they watched several homes on their street go into foreclosure and the fabric of their community seemed to unravel, the Taylors joined other struggling neighbors and sold to hungry investors who descended on the city.
We have sold.
Houston's strong economy made it a hot housing market before the storm, and investors are still swarming foreclosure auctions like this one now, rekindling images from the foreclosure crisis a decade ago.
I've heard plenty of stories of homeowners who had no choice but to walk away.
In Harvey's federally declared disaster areas, 80% of the homes had no flood insurance because they weren't normally prone to flooding. Serious mortgage delinquencies on damaged homes jumped more than 200%, according to CoreLogic. Houston could have seen a massive foreclosure crisis were it not for that strong investor demand. The next city to get hit by a natural disaster might not be so lucky. In Houston, investor purchases of 10 or more properties jumped nearly 50% in the year following Harvey, according to ATTOM Data Solutions. Some were large buyers like Cerberus Capital and Homevestors. Others were smaller home flippers like J.P. Patel.
As an investor, I mean, it was kind of a perfect opportunity.
Patel and his team have bought more than 80 flooded properties so far.
We literally can avoid the whole problematic nature of the foreclosure process.
And it's not over yet.
Sold.
Even a year after Harvey, neighborhoods like this one are still rebuilding, littered with empty houses and empty lots. Some say all of this should be a wake-up call to the nation's banks and mortgage lenders. We asked Ed Delgado, the CEO of a mortgage industry trade association, if the mortgage market is prepared for increasingly severe weather.
I don't think they are. I think if we look at the basic foundation of what drives the mortgage market is the application of credit risk. What's missing is the understanding of weather risk and where those weather events can take place.
Delgado emphasized that most of the damaged homes in Houston were not in FEMA floodplains.
Well, you have this tremendous urbanization, population growth, roads that are being built in the last 10 years. Where does the water go? And is there an underlying risk for us to examine with respect to our portfolio?
Lenders today and the federal government, which backs most home loans, base their risk on current FEMA flood maps. But even top FEMA officials admit those maps do not take into account increasingly extreme weather. Contessa?
All right, so are they going to change the maps?
Well, they're required to update the maps every 5 years, but again, it doesn't take into account climate change, and they do rely on local municipalities for their information. A lot of communities, though, don't want to report flood risks because they're afraid that their insurance premiums will go up.
What a mess. Diana, thank you for bringing us the story and laying out the risk for us. Of course, now